Morning, everyone. Welcome, welcome, welcome. Look at all these faces. I recognize so many of these faces. I'm going to go ahead and turn off our waiting room so we can make sure everyone gets in here. Look at all these people. Welcome, 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 you guys. I would love to know where you guys are all from. I see a lot of familiar faces. Hi, Pansy. Good to see you guys. Drop in the chat. I'm curious where you guys are from. Pansy is in Chicago. Um, I'll introduce myself. I am, for those of you guys that may not know me, I'm Carly Grunman, and I am one part of Opal Equity. And today we are going to talk to you guys about vetting. This is something that I see every time I open Facebook. I see this hot deal alert. And then there's like 25, I'll do it. I'm interested. DM you. Yeah, yeah, yeah. I'm like, oh my God, you guys are way too excited for this deal. It already has red flags all over it. Um, so Carolyn, Christy, and I are like, we should probably show people how we vet deals so we can share the knowledge. We're not going to sell you anything. We just want to give you guys all the information. Carolyn and Christy and I have we raise capital for large operators, and we don't raise capital for anyone. We say no more than we say yes on this. So we have a very, very strict vetting process. If we're raising capital and saying, hey, put your money here, then and we're putting our name on it and our own money on it, you better believe that we are protecting our reputation, our money, and everyone else's money. So look at there's people from Stephen, you're from Gig Harbor, Washington, neighbor. Hello, Portland, Oregon. Peggy's here. Hi, sweet Peggy. Look at all these people. Michael Finch from Roy, Washington. Alita, I can finally say your name without messing it up. Welcome, Alita. Who else do we got here? Deanna Palmer. Deanna Palmer gives the best hugs. Her hugs, I always tell her, could heal the world. So welcome, 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 everybody. I'm going to let Carolyn Briley and Christy Schnurl introduce themselves. And then we are going to get started on some of our vetting practices. And if you guys get to the end, we're going to give you guys our vetting scorecard, which is we have 5 pillars that we're going to go over today. And each 5 pillar has a question that for you guys, if you're going to be investing your money in anything, or if you guys are going to be capital raising for somebody, we have the 5 pillars and then a bunch of questions that you ask and kind of rate on this so we'll show you guys that. We're going to give you our scorecard that we use. I do have to give you guys a disclaimer. We are not attorneys. We are not consult an attorney. Use all of this stuff. Use it with all a grain of salt, but it's what we use to kind of to ask people. So without further ado, I would like to pass it on to Carolyn Briley to introduce herself. Carolyn, how are you?
Hi, good afternoon with everybody here on a Friday. Thank you so much. I love seeing all your faces as well. We see a lot of people here from our You're a Big Deal networking Zoom that we do. So thank you for hopping on over to our educational Zoom. I'm Carolyn Briley. I am here in Dallas, the DFW. Throw a TX in the chat if you're here with me. I know there's always like a lot of Texas family that comes to these Zooms. But anyway, we've been here for, just over a decade and raising 2 beautiful daughters here. I entered into the real estate world with my husband, Myron, about 4.5 years ago. And we dabbled in single family. And I quickly made the decision, I'd say within a year, that feels quick to me. In entrepreneurial years, a year ago, yeah, that goes by really fast. So I veered into multifamily in 2022 and started learning how to raise capital, all the ins and outs of multifamily. We quickly got 2 multifamily properties within 7 months of learning the ropes. And we did that on seller finance. We acquired a 30 unit and a 40 unit right out of the gate within 1 year. And we learned a lot along the way. So being a GP and what all that looks like, what we do when we're vetting, all the ins and outs of that. And then I transcended into raising capital and met these two lovely women who have been uh, my better halves for a lot of this that have led us to where we are today and being able to create Opal Equity, closing on 160 plus unit this past fall in Addison, Texas here. And I'm also a part of the 400 plus unit in Arizona. So it's just been a really crazy, amazing journey. And I'm so lucky I get to do it alongside these ladies. And we're here to teach you what we've learned along the way in the past three. Well, for me, Christy has, you know, a leg up on experience from us. But so we all have our own individual strengths that we bring to the table. And that's what makes us such a powerhouse team. So that's a little bit about me. I am here to shed some light on what we've learned, a little bit of mindset along the way. And we're talking about alignment and vetting here today. So happy to have you here with us and we'll get into it. Christy, I'd love to hear from our president.
All right. Well, I'm Christy Schnurl. So I've been in the multifamily space for, gosh, I think I'm coming up on 18 years now because I'm old. Right out of college, I worked 5 years for a syndication firm, which is just kind of fancy talk for saying that we worked with developers and we helped raise, basically, we connected institutional investors like the big banks and insurance companies with deals, and they were looking for returns as well as tax credits. So I spent all 5 years there in acquisitions. So what that means is I worked on underwriting, due diligence reviews, negotiating partnership agreements, things like that. So during my time with that firm, participated in about $300 million of closed transactions. That was at the fund level. And then since then, I've been working with my family business, CDK, and what we do is, and that's been, I think, 12 or 13 years now I've been doing that. But we work with multifamily developers primarily, and we help them to build more cost effectively. So helping them to reduce their construction costs, helping them to design buildings and projects and units that are cost effective to build. So a lot of consulting work there. And then over the last couple of years, I've took a little bit of a turn in interest. So I am still doing that, but I really wanted to start raising capital because what I found was that I myself was starting to look at investing in, multifamily, and there were a lot of people around me who wanted to do the same, but they didn't know how to look at these deals. They didn't know anything about multifamily. Like they were just in, the stocks and bonds market. And that was the extent of their investing knowledge. So I've become really passionate about trying to share more about multifamily, all of the jargon and terminology and how things are structured so people can start to understand that and feel empowered and be able to invest into it themselves. So knowing that, about a year and a half ago, as these amazing women shared, the three of us came together and we formed Opal Equity. And what was cool about that is that we all have the same shared visions. We're super passionate about teaching, about community, about helping people, and really kind of like bringing people up with us as we're advancing and we're trying to scale and to grow and to get into multifamily in various ways. We want to bring people with us. So that's really what Opal Equity is about. One arm is very much about education, just showing up, sharing what we've learned, what we're doing. And then we also help passive investors to invest into multifamily. Now, the way that we do that, as Carolyn mentioned, is through what's called a fund of funds. So what we're doing right now is we really wanted to be able to scale effectively. And by doing that, we're really just riding the coattails of really experienced operators, raising capital for amazing deals that we ourselves wouldn't be able to do at this point in our careers. So it's really being able to like connect. And so, yeah, that's really how Opal Equity was born and came to be. We have a little saying here if you've been around with us. that learn while you earn. So that's really the goal and mission here of what we're doing. And with that, I'll hand it back over to Carly, and she can share a little bit about how you can continue to connect with us, what we're up to on a regular basis, and then we can kind of jump into things from there. But excited to have everyone here. Thank you.
Thank you guys. I'm so honored that I get to be with two amazing women with so much experience. I always like to put it past them before anything because they are so knowledgeable. So anyways, we meet Opal Equity. We'll get started. If you guys want to we do these Zooms all the time. One of our, like Christy said, one of our goals is, yes, we raise capital. Yes, we're into the multifamily space. Yes, we do all of this. But when we got together, one of our founding principles where we want to help people come along with us. So if you want to learn, if you want to earn, we are going to be doing these educational Zooms as well. So we do, you're a big deal is what we call it, networking Zoom once a month. And that's where we go in breakout rooms. You can ask us questions. And we also do an educational Zoom. I was talking about how we want to do this. We want to help you guys and let us know, like DM us, reply to the text that you guys get. Let us know what you guys are hoping to learn. And also if you go to theopalfund.com/events, you will see all of our events that we're doing. Let me ask you guys some questions. So we'll jump into this. How many of you guys, raise your hand or put a 1 in the chat or say me or do whatever. How many of you guys have wired money over to somebody else, to an investor, to somebody else that is going to use your money and use it to fix up some real estate or do something with it, and then they will pay you back return? So a lot of you guys have. And I'm just curious, how many of you guys have not? I'm just trying to get the feel for this. So we have a good mix. Okay. So if you guys have any questions, there's no such thing as a stupid question in here. Likely, if you have that question, someone else is going to have that question. So drop your questions in here. We have 5 pillars that we're going to go through with you guys. We're going to all take turns telling you about our things, but so there's different kinds of ways you guys can invest money. There's people that might do like PML deals and like loan money on like fix and flips. What we are looking at is we're looking at lead sponsors. So as they told you, what Opal Equity does is we partner with very experienced people. We have like I said, we say no more than we say yes. So we partner with people where it's not their first rodeo. We have vetted the bejesus out of them before we, 1, put our money in, and 2, go out there and be like, hey, everybody, come invest in this project we have, because we want to make sure that everything is safe. So what is a sponsor? Does anybody know what a sponsor is? A sponsor is, put it in the chat. So Corey says, I'm the guy they send money to. So a sponsor is somebody that is going to, in the multifamily space. So we focus in multifamily. It's like a GP or a general partner. It's somebody who, they are like Corey said, I'm the guy they send money to. The sponsor is the person that is taking your money and making it grow, hopefully, and not losing money. I heard Carolyn say this like a couple months ago, and I'm like, this needs to be tattooed on everybody's forehead. Fund manager. Yes, Jose. It is a fund manager as well. Experienced operator. Yes, Erica. It's somebody that's taking your money and making it grow. So Carolyn said the other month, it's not if you lose money in real estate, it's when. And it's going to happen. Even the best people who have the best intentions, markets change, things happen, crap happens. So it does happen. But with the vetting system, you need to vet them because you just don't want to roll the dice with that. You don't want to be like, well, here's 50K from a webinar. Hope it comes back. So we don't want you guys to gamble. We want to, if we're using the gambling terms, let's stack the deck in your favor. Let's make sure that you guys know what you're doing. And so we are going to talk about our vetting system. So the five pillars that we go off of is the sponsor team, the operator. Remember, we just had fund manager, the people taking your money and going to make your money grow, right? Number two is the market. A lot of people will not want to only keep it in the United States. And they also want to keep in like a highly populated area. So there's a high chance of it selling again and be us able to recouping our money, as well as the asset. So we want to look at the market and the asset. We don't want to do, let's say, a multifamily if there is oversaturated of multifamily, or there's very strict rules against multifamily and it's going to be hard to do it in. Three, we look at their business plan. What are you doing? Their return structure. How am I going to get my money back? How much am I going to get? How long is it going to be? And then communication and reporting, because what is worse than you being like, here's 150 grand. And then they're like, peace, see you in 5 years. You want to know what's going on with your money? How's it going? What's going? Show me pictures. One of the things that we do is when people invest with us, we do an asset tour. So we have that one in Addison, Texas. And we're going to start coordinating a site tour. So we're all going to go to Texas and we are going to hang out at the courts at Bentry, and everybody can walk the property where their money is in. So I'll go over the first one. And if you guys have any questions, drop it in the chat. So the next one, will you go to the next screen, please? Okay. So remember, we just talked about this, the sponsor, the operator, the general partner, the fund manager. So we want to look at these people first. This is something I see all the time. People have very good intentions out there. They have the best of intentions, but they're like, hey, I need $1 million. And the first thing I think is, you've never done this before. And that's fine. But as long as you're partnering with someone that's had several deal cycles. So what's a deal cycle? A deal cycle means I've raised money, I've fixed up the asset, I've sold it, and I have paid everyone back. It is complete. It is finished. Yes, Jose, we will give you a copy of the slides for sure. So the first thing we want to look at, I think all three of us are very good at reading people, reading between the lines, sniffing out the BS. Our nose sniffers are really good like this. So the things that we're asking, if somebody is like, hey, can I have 50 grand of your money? How many deals have you done? So that's the successful deal cycle. Look for one of the questions we ask is, awesome. How many deals have you done maybe in that market? How many successful deals have you made? We will not do anything with anybody that has 0 deal cycles. Like, they could be in the middle of something and it's just not wrapped up yet. We want to see that they've successfully completed and returned money and everything was hunky-dory. At the very minimum one. Past mistakes and how they've handled them. Just like I said earlier, it's not if you lose money in real estate, it's when. Shit happens, excuse my French. It's not good. But it's how people respond to that. And they take accountability and be like, you know what? I made a mistake on this. It was such a big mistake. I know I'm never going to make it again. This is how I made it right. These are the steps that I took. These are the steps that I am ensuring that doesn't happen ever again. We've put in 1, 2, 3, 4, all of this stuff. Mistakes happen. You guys, we're all human. And if somebody says, I've never made a mistake in my entire life, I am Mr. or Mrs. Perfect, I would be like, that's possible. But is there any accountability here? Is there self-awareness here? Christopher says, I call BS real quick. Exactly. Another thing, any capital calls. So does everybody know what a capital calls are? I didn't. That's a new one. When I was getting, that was one that it was kind of like a higher level word for me. So a lot of you guys don't. So a capital call would be like, let's say I am a very experienced operator. I've successfully raised money from all of you guys, and I'm reporting, and you guys send the money over. And then in one of my reports, I'm like, you guys, the market shifted. We need some more money. Can you guys help us with more money? So these are not, they're not like, oh my God, they had to have a capital call. I'm never working with them again. That works. That goes with along the same vein of mistakes. Like stuff happens, market changes, things happen. So has anybody been like, hey, so and so, can you guys wire me some more money? Because we need more. So we say, how many times have you had that happen before? What were the circumstances? Here's a good time to be like, look for that where you read between the lines, look for that accountability, look for how they have fixed it, look for that. If they say, never, I'm perfect, I am so perfect, and I've done 10 million deals, I call BS on that. Like stuff happens. And then also,
Can I interject really quick on the capital call thing?
Yes.
So this is a term that for those of you that are getting into multifamily or you start exploring these investments, this is a word that's really common that's going to start coming up because of where we are in the market. This is something that specifically in multifamily investments over the last 18 months or so and projected still like into this next probably 6, 12 or so months has been a very common occurrence. And it's not necessarily that the people running the deals are bad operators or bad GPs, but there are a ton of capital calls that have happened specifically because of financing. So I'm sure what a lot of you might be aware of if you haven't heard of capital calls, but you might be aware that in multifamily specifically, there were a lot of bridge loans. So what a bridge loan is like bridging you go in to execute your business plan. Maybe there's renovations, things you're doing with properties. So they would get these bridge loans. And what was a very common practice was to do, because financing was very reasonable, low rates, was to do a floating rate. So they would have these floating interest rates. And then what happened, right? All of a sudden we had rates skyrocketed. So what has happened in the market is that there are a ton of properties that have gone underwater. They've turned upside down. They can't afford even the debt anymore, much less pay anything else. Because they're just too expensive. So there's a lot of other factors. It's a little bigger than that. But as a result of that, you have a lot of people out there right now that are running these deals that have done capital calls. So they've called their investors and they've said, hey, listen, we're in a bad position. We're going to lose the asset. All of your money is going to be gone, but we think we have a plan. Some of them are good plans. Some of them are not. Some of it's a Band-Aid. That's where really like the communication matters. But like capital calls, are something I just want to kind of raise that it's something to look at and to ask the question. A lot you will start to see have had capital calls, but that doesn't necessarily mean that you need to like run for the hills if someone has. That's where it's like, and this is true of almost everything we're going to talk about today. There's nuance and context are so important. So we're covering some very high level pillars to consider. But the story behind it and the information behind it and the context around it is really what matters. So anyhow, I just wanted to interject with that and kind of give a little bit more context for those of you who aren't familiar with capital calls and what's been going on.
Thank you, Christy. Thank you for elaborating on that. And what we're going to be doing also when we give you guys our checklist, we're going to be giving you our vocabulary guide because there's a lot of things like what's a sponsor, what's a GP, what's an LP, what's a capital call. There's all of these things where that's one thing about multifamily is they're like, let's make as many acronyms as possible. And let's just not call it what everyone else calls it. Let's give it its own name. So we're going to give you a guide to decode that as well, if you guys are into that. So Stephen says, so a capital call would be when a project runs short on funds, needs more money to finish a project. Yes. Usually, like Christy was explaining, like because of the market or an unforeseen circumstance. So yes, they're like, hey, you lent us money because of whatever reason, we need more. Jose asks, it's not a standard procedure, but is it possible for any deal? It is. Yeah. It's very possible to, because what people are doing is they're underwriting and they're seeing how much things are going to cost and their projection based on stuff. Like no one has a crystal ball. So we're all doing the best we can with what we have at the underwriting. And a lot of us will be very conservative. So we'll put some cushion just in case. But it's very possible.
There's also Sorry, just one quick
Yeah.
thing. There is also some sponsors will structure. This is just so you know if you do go and invest. Some will say, like, you'll make your commitment and say, I'm going to pay $50,000 or $100,000, but they won't take your funds yet. They'll wait. And so you're basically committed, and how they will structure it is at the time of closing or right before closing, they will do a capital call. So that term you might also hear in a sense where it has nothing to do with like them not having enough money or something unexpected has come up. It's just the way they're structuring the deal for when the capital comes in. So it's really just that call to investors of, hey, time to wire money in. That kind is not optional. That's where it's like you've already committed and that's just the point at which you're putting in your funds versus depending on the deal, the other ones may or may not be optional. So sorry, again, a little bit of nuance, but just thought it might be important there to throw that in.
Thank you. Yes. So Joseph asks, is the previous use of floating interest rates a potential flag? How has the operator changed their funding strategy? I'm not familiar with floating interest rates as much as Christy is. Christy, what are your thoughts on the floating interest rates?
So this is one that I would say is highly subjective. And a lot of it's going to come down to you as an investor yourself, or you as someone who's like partnering with someone else or running your own deal in terms of how you want to structure things. I can say that a lot of sponsors are responding to this market and responding to investors by saying we are doing fixed debt because it feels like the most conservative thing to do. There are some that are out there right now saying it still doesn't make sense to do the fixed debt because rates are adjusting, they're moving, a floating rate makes more sense. We feel confident. So again, it's not necessarily that one's a red flag or the other, but it's an area to ask questions and to understand the mindset and what they're thinking behind it, right? So most right now are doing fixed though, from what I've seen and heard.
Thank you. So capital calls, you're going to hear that a lot. That's something it also shows when you ask that you know what you're talking about as well. And then the depth of the team and the operational strength. So how big is the team? Is it just the operator, just me, myself, and I, no team, only relies on me? So we want to look at their team, their experience, things they've done. You really want to dive into the sponsor, the team. This is going to be the skeleton of the strength of all of this. You want someone very strong and very experienced because, like I just said, there's no crystal ball. Poop happens. And we need to make sure that whoever has your money and you're wiring over your hard-earned cash to, a lot of it's anywhere from 50,000 to hundreds of thousands of dollars. It's hard-earned money and you need to make sure there's no guarantee it's coming back. So you need to do everything that you can ask, put life jackets on, put boomerangs on, whatever. These are all the things that are going to help your money come back in the questions that you ask. So any questions on the sponsor, the team operator, before we move on to the next one? Is there another? That's it for this slide, right? Yeah. 2 is deal structure. So
I love that. Put the boomerang on.
Yeah, put the boomerang on it. I want that money to come back to me. I do not want it to die.
I'm gonna start using that. I love that.
Yeah. Good. You should.
Okay, so
Dana has a quick question. Or should we do questions at the end? Or should we do questions?
I'm okay with answering it now. She might need to hop later.
Okay. Dana.
Hi, Dana.
I can't unmute her because I don't have host anymore. Christy, you're gonna have to do it.
Okay.
Sorry. If you give me co-host back, you can keep host and give me co-host. I can do the driving behind.
Thank you. Got it. I appreciate that. Good morning. I know we asked them in regards to vetting them. Sometimes, for example, I've asked people that are like, yeah, I'm a buyer, please send me your deals, yada, yada, yada. And I ask, oh, what other projects have you done? Can you show me that? Like, I see the questions that you're asking, but anybody can say those things. Are there any forms or things that you can ask that aren't crossing boundaries that they would share with you that is not a story? Do you know what I mean?
Like paper proof. You're looking for.
Like, right, show me a project, or are there documents that you ask for, or you don't want to say, maybe you do want to say, I'm not that confrontational, show me proof. Do you know what I mean? Like, how do you verify what they're saying as well? You know?
Yeah. So,
I mean, yeah.
but no, go ahead.
I mean, personalities and radar, and you can tell someone's kind of full of themselves. And so right there, you don't have to ask for anything.
Yeah.
But to progress, just to have, hey, can I have this for my reference? I'm sharing it with my group or my team, or like, where do you ask or what do you ask for beyond that? Or are you getting to that, or do
Yeah.
you, or
That's a great question. So just like in lending with anything, be like, awesome. Can I have who are some people that lent to you? And
okay.
like you're vetting for a job essentially. No one's gonna be like, yep, I have a doctor degree, just hire me. And they'll be like, okay, they want to make sure that they're gonna call people, they're gonna call references, and ask for proof. And you can always tell if they're like, that might
Right.
be a red flag.
Okay.
Yeah.
Thank you. So references. Got you.
References is a good one.
Thank you.
And I just dropped, this is a really great website to bookmark. This isn't going to work for everything. What this is good for is if the person has had to file with the SEC. So when you are putting together a deal like in multifamily where there's large deals,
Securities involved. Yes.
Usually, most often, it's considered a security. So what happens is they have to, because they're selling a security, they end up filing an exemption, and there's some special exemptions that they file. And when they do that, they end up on this list. So if you search for someone's name or you're searching the different names of the people involved in the deal, they're telling you that they're involved in those, then you should be able to find it on this website. This is the government, the securities search.
And what's it called? Oh,
It's Edgar. And so I just dropped it's sec.gov/Edgar/search. So you can do that as well. But usually also Google will go a long way. I will say too, if these are larger deals, especially in multifamily space, or they're larger syndication firms, their website is going to show which deals, but to your point, it's like, is that real? But usually if you can search people's names, search these, sometimes there's PR releases around the time, like acquisitions are a big deal when you're closing something and it's like a $50 million, $100 million or something. There's usually some press around it or people discussing the transaction. So that would be a way. Local brokers, if this is someone who's in a certain area, you can always reach out to brokers that are in that area. Hey, have you heard of this company? Or other property management companies at those places. Like there are other third parties that, if someone is established, that are going to be able to say, yes, they've owned or operated this property. So.
Yeah, this is really good. So when you guys see this could be a red flag or a green flag. So if you see somebody being like, I'm raising a bunch of money for millions of dollars for an asset where you're pooling money. So like if you're a private money lender, you're getting a lien position on the house. But if I have 150 investors, we're not having lien position 3, 4, 5, 6, 7, 8, 9, 10. You're pooling all this money. And if you guys Google the Howey test, HOWIE, we also have a handout. Maybe we can find it and put in here on finding out. That's one thing you can be like, oh, great, you're raising and pooling other people's money. Awesome.
Correct.
This is a security.
Yes.
Yeah.
And kind of back to the link that Christy dropped for the Edgar search on like if they did file with the SEC, that should be in there. I think that is something that should be kind of triggering in everyone's mind regardless. If you take a look at that Howey test that we just dropped a link to on like what that all entails, there's 4 checkpoints that need to be checked. All 4 need to be checked. And if all 4 are checked, it isn't most certainly a security. You are selling a security, or whoever it is selling a security, and that needs to be filed with the SEC. So if you run across a deal and you happen to say, okay, let me just like run this through the Howey test, let me just see what their information is, and does it check off with the Howey test? And then let me go see, okay, yes, it looks like it is selling a security. Let me go check and see if they filed on Edgar, right? And if they're not there, then that gives you another question to come back and ask. Okay, according to my information and what you've provided me, this looks like it checks out all 4 prongs of the Howey test, and that this is in fact selling a security. Have you filed with the SEC? Have you filed your exemption? Like, these are serious questions you need to be asking and considering when you're looking at deals, talking, vetting, all these things. It's not just like, oh yeah, it looks like everything looks professional. I'll go check that SEC site later, or I don't need to run it through the Howey test because they've done a couple of deals like this before. Well, that's where things need to get a little bit tricky. Anyway, thank you. Thank you for the great question, by the way, Dana. That was a good question.
Lee, did you have a question? I can't unmute him.
Oh, that's right. Sorry.
Just give me co-host and I can unmute him.
I don't even know how to give you a call.
I'll give you co-host.
Thank you. I gave you host and lost
Oh
my
crap, I
co-host
can't
powers.
give you co-host because I'm
It
co-host.
has to be me. Okay.
Okay, so just click on the 3 dots next to her, and then it should say make co-host.
Okay. Got it.
Okay.
One of the things I just want to say, when you are asking for, have you done any deals, ask for their closing hot documents, right? Or CDs if they have closed and private deals. So this way, you know exactly how many deals they have done. And the hot documents will show whether they have lost money or they have made money, just a FYI.
Yeah.
I don't know if do multifamilies have HUDs? HUDs is mostly with a single family, isn't it?
Yeah.
Like big, yeah.
So I mean, that's all. Yes, I agree. Like that's all part of the vetting. However, like to add a layer onto what Lee is saying is you need to be asking these potential deal sponsors, whoever, how many deals have you gone full cycle on? Like, is this your first rodeo? Like, what are you doing here? You're pulling money together, or whatever that might be. That's a great question to ask. Like, how many other deals like this have you done full cycle, and what were the outcomes? And a transparent, aligned sponsor should not have any issue sharing that type of information with you, right? If
should just be common.
Right. That should just be common. Unfortunately, it's not. And everyone, or no, I shouldn't say everyone, a lot of people do put up smoke and mirrors about things. And that's why we're having this Zoom, right? Because it's becoming more and more important to take these things into consideration, especially when you have not only your money on the line, but this is your livelihood, this is your future, this is your family's future. All of these things entailed into what you're vetting and what kind of deals you're doing, right?
And one other thing, and then we can move on, that it just reminded me, sorry, this was
go for it.
Is I remember we asked this in our Funds of Funds formula course when we were talking about vetting a deal sponsor. And so I said, all right, given all this information, Christy, Carol, and I, you guys, we told you at the beginning what our experience is. If we came to you guys, we're not doing it right now, and said, we need $50 million or $1 million for a multifamily project. We're raising money. Would you, hypothetically, you had it and you were looking for an investment, would you invest with us right now? All hypothetical. Yes. Just put a yes or no in the chat. Or what questions would you ask us? No. Thank you, Christopher. That's right. We have all three of us have not completed a deal cycle, but one of us is in the middle of a deal cycle. Carolyn, when's your deal cycle going to wrap up?
In 3 years.
In 3 years. So in 3 years, we're not even going to probably ask anyone for money until at least one of us on this team do for our own money, not for a sponsor, for somebody else, for 3 years. Because we are going to practice what we preach. We're not going to ask people for money if at least one person on this team has not completed one successful deal cycle. So keep that in mind. A lot of you were like, yes. And I love that. Thank you for instilling trust in us. Carly said, I love you, my granddaughter. I love you, Peggy. Thank you so much. Yes, Christopher's asking the questions. Great questions. Yeah, great question, Roger. What's the experience on the generation of your property? So if something was built in 1900, there's a lot of stuff going on with that. Like, how old is the plumbing? How old is the electrical? Have you dealt with these old historical things? Very good question. Good call out, Roger. I love that. What's their total scope on the property? Yes. So I think we're going to get to something on that later too. Thank you.
We do have a section on that, but that's a very
good call out, Roger.
Very good call out that can easily get overlooked if you don't know what to ask or look for, if it's like, the sparkly object syndrome when you're ready to invest, right? Things kind of fly out the window when these pretty deals come up, right? So, okay, we're talking about deal structure and alignment here. So what we're going to be looking for is skin in the game, reasonable and transparent fees, and structures that favor LPs, not limited partners, not just the general partners, GPs. So when we talk about skin in the game, we're referring to personal capital. So let's say a sponsor, and I'm just prefacing here, these are just hypothetical numbers. This is not pertaining to a real deal or anything. Let's say a sponsor is raising $3 million, $5 million for a deal. But let's say that sponsor is only putting in $5,000 of their own money into the deal. Would we necessarily call that skin in the game? Or would we maybe refer to that as like a manicure? I don't even know. Like, compare that to an operator. Now, take the same scenario. The $3 million, $5 million deal a sponsor's raising for. And they are now putting in $200,000 of their own personal capital. If something happens to go sideways, maybe the HVAC has an issue or something comes up on the property, that who do you think is going to fight harder, right? Like if a sponsor has that much money of their own money in the deal, they're going to, the team that bleeds together wins together type of mentality, right? Like you want to see that sponsor is putting in meaningful capital and they're not just managing the money. They're protecting their own money right alongside yours. That's what I would call alignment in skin in the game. I've seen deals where GPs just invest no money because they just want to collect all the acquisition fees up front and all the things, and they still get paid even if the deal underperforms. And that's a red flag to me, right? Let's see, for reasonable and transparent fees. So again, imagine listen, before I say this, like, we love to get paid. Raise your hand if everyone loves to get paid. We all want to make money in business, right? We all want to make our fee on something we work hard on, correct? So there's everybody's raising their hand because they love to make money. I love it. Or maybe you guys have questions, but we'll wait for just a minute here. So let's say, imagine the sponsors charging or creating the fee of a 3% acquisition fee, a 2% asset management fee, a construction management fee, maybe a refinance fee, and all these things. Are these fees always considered bad? No, not necessarily. So what I mean by that is we need to have context and transparency from our sponsors, clearly explaining, here's what each fee is covering, here's why it's reasonable, here's how it supports the business plan, right? You want to see a sponsor being able to clearly and confidently break down what these fees are. Again, they are not bad. Everyone should be rewarded and paid for their hard work as long as it's in alignment and it's clearly communicated to their potential partners and investors, right? If they cannot explain it clearly, or the fees look like they are just getting paid regardless of performance, again, that's a big red flag and a big pause button for us. We're not going to be doing that. We're going to be looking at like, what do these numbers mean? I'm going to take a drink of water. And then we will go to the last one here is structures that favor the limited partners, not just the DPs. And that just ties into the previous one. This is something where this is the easiest way for the beginners to start spotting the misalignments, because there are deals out there where the GPs, the general partners, the ones who are like acquiring the deal, underwriting the deal, getting the deal under contract, everything like that, but they want to take a large chunk of the deal. Usually when you're starting out, GPs do not take a large percentage because they want to show good faith to their LPs. When a GP is maybe taking 40 or structuring a deal that's maybe 40 for 50% of the deal, and the LPs get paid after GPs collect their fees, or maybe they don't do preferred returns, or they're just doing a lot of things where they're putting themselves as GPs first, even if the deal barely performs, you want to avoid this, right? You're wanting, like, if you have limited partners and trusting their money, their time, their energy, their faith in you in this deal, you want to, they're at the top of your priority list. And if you, the GP, are putting in a good chunk of personal capital, skin in the game too, you should have that same mindset, right? Like you are wanting to be a good steward of that money and that investment that someone is giving to you. So when a GP is creating favorable terms more for their side versus the LP side, that's a big pause button. That's a big red flag that we want to avoid. Let's see. Let's go to market and asset specific. So these are some points that Roger brought up just a minute ago. So we need to be looking at, let's zoom out and just take a look at the market and asset itself, because we're needing to look at the job and population growth. The business plan should align with the property type and the condition. So the job and population growth, are people actually moving to this specific location that you're being presented on? Are the economic drivers, are there multiple industries here, or is it just dependent on one? Is it just like a city with one big factory and everybody works there? Or is there life breathing into the city? Is there life breathing into the location, right? We always like to see, what do we like to see? We like to see a Starbucks and a Chick-fil-A being built near an asset, a multifamily asset that we're looking at, because we like, oh, okay, the population is growing, it's booming, there's good enough resources and job stability here to put these close, right? Business plan versus the property reality. Does this plan match the asset itself, or is it kind of built on a house of cards, right? So again, to Roger's point, we have a value add that only works when a market supports the rent increase. So if it's a 1970s building, which would be a C-class building with a C-class tenant base, let's say, that just doesn't magically become a Class A because your pitch deck, your slide deck says so, right? Like that just doesn't happen overnight. There has to be real demand and real comps, and the feasibility needs to be there for that to make happen. And we see there's like a lot of trends and hot things going around on the internet and through all these communities. So this is a really big pause question on like, what does this actually mean? Does the market support the asset? And then I think our next slide is risk management. Awesome. So strong operators have a plan ABC for when things go sideways. So how prepared is this sponsor? How prepared are they for real life? So what am I asking when things go sideways? We're going to go over sensitivity analysis and stress tests, all of the what ifs and the possible scenarios, the adequate reserves, insurance, debt terms, contingency plans, all these things. So a sensitivity analysis at a high level, and I think we have this in the vocab guide as well. Yeah, we do. Okay. So
Yeah,
all of the majority of these terms, and we'll be updating it too, as you have it, we'll have these terms in there so you can refer back to them. So sensitivity analysis. So this is just like accounting for the worst case scenarios or the best case. Like what happens if the occupancy drops, if the rent growth slows, like all of these different things. A strong operator will be willing to transparently share with you. And adequate reserves. Do they have enough cash set aside for surprises? I know with people that we've worked with before, if things start to go sideways, they are putting up their own money and have adequate reserves on the side to where they will not be touching, they will put their investors' capital as the very last resource that they call on to bring in if something were to happen, right? Like they want to make sure that they're taking care of things as largely as possible, as closely as possible, confined before they call in their investors for a potential capital call or things like that. So it's adequate reserves like that. Insurance and debt terms. So are they locked into something stable? Again, this kind of goes back to the floating interest rate, or is the debt structure adding unnecessary risk? So these are all questions. And again, Christy said it was subjective because a floating interest rate might make sense for some specific deals. But again, it constantly goes back to like this, it's deal specific and sponsor specific of you need to be asking them, okay, if it's having this type of debt term or interest rate or whatever it might be, does this actually make sense? And if you have further questions, they should be able to confidently explain it and give reason to why they're structuring it that way. And if they're giving you, if they're trying to dodge bullets, again, that's a red flag for us. Yeah, we don't want our sponsors saying like, oh, just brushing you off and saying, don't worry about it. And like, feel free to wire your money over, right? Like that's just not gonna fly over very well. So yeah, that is all the things that we look for in risk management with our operators and sponsors and just having all of those contingency plans in place.
Yeah. Knowing that someone has like thought about, okay, this is my plan. This is the best plan, in my opinion. But I know that plans don't work out and unexpected things come up. So it's like looking at possibilities, right? Like, okay, if I'm doing a floating rate, what if rates go sky high? Can I support it? What do we do at that point? What would the turning point? Like, you don't want an operator who's always having to make decisions and come up with plans when those things happen. Yes, that's going to happen in life, right? Like you can't like predict everything, but there should be a lot where they can think like, okay, what are cap rates going to look like at the time that we exit? What if they're not? What if they're higher? What if they're lower? What does that do to the value? What does that do to returns? What else could we do? If we can't sell, if we're struggling, what are the other options? Can we refinance or can we do something else? It's like that's where like the plan A, B, C, D, E, whatever comes in. And so up front, you just want to know, and like your role in this is like asking the questions like, okay, I get what your business plan is. This makes sense. What if that doesn't work? What if you renovate the units you're saying you're going to renovate? And you can't raise rents like you think you're going to raise them $200, per unit per month. What if you're only getting 100? Or what if like the market, you think that the market rates are going to increase organically by like 2% per year, and what if they don't? what's the plan then? Or like what would that look like? So it's really just about thinking about that and asking the questions and getting them, the communication there and knowing that they've thought through those things and are mitigating any risks to the extent that they can up front.
Love it.
All right. And then that brings us into the fifth pillar that we're going to be talking about today, and that's investor communication and reporting. So before I jump into that, the way that we structured these five pillars to share with you is kind of how we think about them. So in the very beginning, when Carly was showing that slide, it was designed as kind of this funnel. And there was a reason that we did it that way, because in our minds, and this again, this is where it's subjective. You might have a different opinion, but in our opinion, the sponsor is the most important thing. Like you could have a golden deal that's amazing, but if you have someone that you don't trust or that has had bad practices in the past or has never run a deal, whatever the things are, right? If the sponsor, the person behind the deal is a huge red flag for you, like for us, we stop. We're like, I don't want to look at the rest of the things. I'm not going to go through this vetting process and continue. So for us, the way we think about it is it's sort of this funnel. And it's like, okay, how are we feeling at this level? Cool. Let's keep going. How do we feel now at the the market and the asset level? Okay, let's continue. And you're really, this is a high level vetting that we're showing you today. And even the investment scorecard that we're going to drop shortly is very high level. It's just to kind of start thinking about it in these different ways, different pillars, different areas to vet. And as you get more comfortable with it, you're going to start having your own things you like to ask or look for. You're going to dig deeper in different areas. This is really just to help like start thinking about, how do I recognize a red flag? How do I recognize a green flag? Like what am I even looking at or looking for? So the reason I mentioned that, this is the fifth pillar, in my opinion, still very important. But again, it's not going to be the most critical thing. It's not the first thing I'm going to ask or look at, because if none of the other things that we've already talked about are looking good, I don't really care what their investor communication and reporting is like, because I'm probably not investing in this deal or going to be involved in this deal. So really with this, what you're looking for is just kind of getting some level of expectation from them on what their investor communication is and making sure it's in alignment with whatever it is that you would like and you are comfortable with. There are some sponsors, operators out there that do minimal reporting. Like you literally will just kind of, maybe get an occasional distribution. You'll get your tax documents like a K-1 and never hear anything about the project. And maybe you're busy and you don't care. And you're like, as long as you're making me good money, I'm good with that, right? There are other people that are like, I would love to know what's happening on a monthly basis or on a quarterly basis. So just understanding if the person you're investing with, that matches, right? Or it's like, okay, I'm good with just getting an email that's giving me an update, or I'm good with like, I would love to see some sort of formal report, or I would love to see a quarterly Zoom call where I have the opportunity to want to like to ask questions live, or whatever that might be for you. So that's really, this one is extremely subjective, and it's not really meant as like, here are the red flags in like a deal or a person. It's more of an alignment of what you're feeling comfortable with. It's your money putting in. What's going to make you feel comfortable after, because once that money hits, like you are married to the deal until that exit, when hopefully you are getting your money back and you hopefully are also getting a return, right? You might get a return along the way, or maybe it's at the end. Again, that goes down to the business plan. So this is really just about understanding that expectation from the sponsor. What am I going to get? Am I good with that? So with that, in summary, because a lot of this just really comes down to understanding the risks, right? At the end of the day, that's what we're talking about with all of this. We're trying to find some red flags. We're trying to understand where we're most at risk. Are we comfortable with that risk? Does it match our risk level when we are making an investment? What is their pro forma? What are their projections? Do we feel comfortable with how they've underwritten it and what they're projecting? Is it conservative or match the level of like what we think? What is their level of experience as an operator, right? This is sensitivity analysis, those stress tests, like, and what are the exit strategies? What's the plan ABC here of like how you're planning to make my money get money? Like what's happening here, right? To get our return. And then just remembering, it's like with any kind of investment, real estate has risks. Almost all investments have risk, right? It just matters how you're mitigating it and making sure that whatever the level of risk is matching your return there. All right. And this is just because, again, we love learning and we like to encourage people. I know it can be scary to take a step, but it's important to just start learning. So if this is something you're interested in, whether making an investment or getting into multifamily yourself to like run your own deals eventually, or to raise capital and to partner with people with like fund manage, do like a fund of funds or something like we have done, you know, you have to start somewhere, start learning, practice looking at deals. You don't have to commit. You don't have to actually invest your money. You can still practice going through what we're teaching today. Okay.
And I want to kind of, if you don't mind, Peggy asked a really great question. And she says, where do we report the people that have cheated so many of us? There's really not a lending police department that you can report people to.
Oh, that's why you were saying that.
Yes, that's so there's but you know, if it's a really big one and there's a lot of stuff, you can report it to the Securities and Exchange Commission if they're doing things wrong. The SEC can go after them. But that's why it's so important to vet a deal. And so important because I tell people over and over again, like I host the Gator New Welcome Zoom, and I'm like, your money is made or lost before you sign the papers and you wire your money over a lot of the times, because there's people don't vet. So it's so much easier, or they do to lose their money. And they're like, oh, so-and-so just seems like they have good vibes. I just like them. Don't lend off vibes, or if you like them, or if they have a million followers, or if they've got hype, or they make you feel really good. You do not trust anybody. You verify. You do not trust, you verify. And that is the one thing that will protect your money, because there's no local police department if it's really, really bad, the police can probably do something about it. But really, for like people that got you, it's extreme accountability. It's only your fault because you did not vet them. And it's a very expensive, gut-wrenching mistake to learn to not vet. So that's why we're like, vet the bejesus out of anybody before you send over money. Like, just don't be like, sounds good to me, here's 50 grand for 100 grand. So I just wanted to point that. That's a really great question, Peggy. And that's exactly why we're doing this Zoom. So Christy just dropped our scorecard in there. So that's our exact scorecard where you can put numbers in there, ask the questions. Here's a note. You guys are not going to be able to fill that scorecard out. I should probably put something in there. If we don't have it, we might have something. You have to do file, make a copy for every single one that you do. File, make a copy. Do not request edit access. We won't give it to you. You have to do file, make a copy for your own.
Mm-hmm. And then you'll have your own and you can score them.
Yes.
We did not. Let me pull up to show you guys what that looks like. And we'll quickly walk through how to use it. And it basically mirrors the pillars of what we did here today. So let me stop.
And while you pull that up, Jose, I read it like it's Jose said, is there a blacklist for the community? So there's a blacklist. I'm going to be controversial here, is lazy. You're not vetting. Just be like, oh, I heard there's like scam groups and there's blacklists. And I'm like, this is ridiculous, because people can weaponize those. Even if somebody is a really good person, they did everything the right way. It's he said, she said on these things. I could be like, Joe Blow made me mad because they called me fat or something. So I'm going to go tell them I'm going to get them on every blacklist. They're going to weaponize it. Do not do blacklists. Do not look for that. Do the hard work. Vet them. Ask for references. Ask the questions. Do not rely on a blacklist. And I am going to die on this hill. Those scam groups are dumb. It's all he said, she said. They're They're dumb. You do your vetting. Jose's like, okay, I got it. Yeah, Jose, some deals may go bad, but the operator in bag of practice just ran off with the money. Yeah. So definitely it's all reputation. Everybody has a reputation. So it's gonna get around. People talk. All right.
Okay. So here's the scorecard. Again, I want to remind everybody, this is high level. I know it might feel overwhelming because we've talked about a lot of different things today. And if you're brand new into this space or hearing these terms for the first time, it's going to feel like a lot. So just take it slow. But this is just to cover what we think are main areas. There's a lot more vetting you could do. This could be way more extensive. We're actually working on a vetting guide right now. I've been working on it for months, and we've been behind the scenes trying to figure out how to make it user-friendly because it's a beast. This thing is like 50 pages, and we don't want it to scare everybody. But it goes way more in depth about a lot of different things about all different aspects of these pillars. So in the meantime, this is more of a high-level look, how you would use this. Each of these lines up with what we've talked about today in the presentations. These are the 5 pillars. We have the 1, 2, 3, 4, 5. And within each one, we have kind of some high-level things to be asking and to look at, right? So we have like, what does their track record look like? Have they ever lost money or done capital calls? And what you do with the scorecard is you're just going to, this is your own ranking, 1 being the lowest, 5 being the highest. This kind of just helps you to quickly have a visual and to see like, how do I feel about this opportunity, you know? And if you're not really sure, it's like you can always throw something in the middle there. But you're going to go through each of these and see how you feel about it. Again, super subjective. We don't have like a ranking within here. We wanted to be careful with like us advising or saying this is a 5 if it's this criteria, this is a 1, because there's so much nuance in these deals and there's so much context. So that's something that really it's going to be a skill that you just need to practice and learn. But you're going to go through, score each of these, and then down here it totals your score and it gives you what percent out of these. So the way that works, this totals to 75 points. So this is saying basically that if this were true, that it's about a 51%. So do with that as you will. If you feel like, nope, not a deal I feel confident enough in, because it only like has a lot of red going on here and it's at 51%. You know, you decide what your thresholds are and your level of confidence with the deal. But really this helps as a visual check too, to see like, you know, we mentioned earlier, we think about it as a funnel, where for us, the sponsor really is one of the most important aspects. And if this doesn't pass for us, we don't really care what the rest looks like. So if I'm looking at a deal and I start going through and I'm seeing all red flags right here, I'm probably pretty much done vetting it. I'm like, okay, pass. But that's just me, right? And so then you move down. So again, it's like we've got the investor communication reporting is kind of hanging out down here. But if that's more important to you, then it's like, you know, maybe you rate these first. So anyhow, this is for you to use, just a useful tool as you're, you know, starting to look at these kind of deals. If you click in to this cell, you'll get access to our vocabulary guide. So that is what we mentioned earlier. It has a lot of the terms that we've brought up on this call that we talk about on other calls, words that you might find in the investment scorecard. So if this is something that is newer to you, I would highly recommend clicking into here. Again, this is view access only, so you're going to have to make a copy of it if you want to keep a copy of it for yourself. Otherwise, you can just access it, you know, through the scorecard. But yeah, I can drop the link to that again for you guys to go ahead and download. We also we'll send out a replay, a recording of today. When we do, we'll include the link to this as well. So if for some reason you're not able to grab it right now, you're driving or something, please don't crash trying to like grab the link. It will come to your email in a few days. So let's see. With that, I think we are good to.
Will you show them the instructions So that, can you just do a call out? Can you do a call out on how to file, make a copy, and then show them can we just call out the tabs at the bottom so they can see those?
Oh, yeah, yeah. Okay, so when you open it, it should land on this instructions tab. Really, this is just giving the disclaimer. This is for like entered educational purposes only. It's not meant to like replace a financial professional or someone else. This is just a tool for your own use. This is just kind of telling you the levels here for scoring, 1 being the lowest, 5 being the highest. And we have just kind of some information about us, some net steps if you want. This is not linked yet, but we actually will have this class linked directly in here. So if you need to come back, you want to see any of the areas we talk about in the scorecard, you want to review what we talked about today, in a few days, this will be an active link for you. But when you get this, you will go to File, make a copy, and then just share it or save it wherever you want on your own drive, and you'll be good to go.
And you can fill it out.
Yep.
Do you guys, I see some questions in the chat. Do you guys, Dana asks, and if you guys have questions, raise your hand. Dana asks, do you have any advice regarding an attorney for review of any contract that you are working on? Any clause, in the second question, is it a red flag for a sponsor to only put a small amount of money into the project of their own because they are involved with multiple other projects? I think a big red flag is they're not putting any of their money on at all. That's the hugest red flag. They just want everyone else's money.
I think to piggyback onto that, is it a red, your question was, is it a red flag if they're putting a small amount of money into a deal because they have multiple other projects going on? My other tangent question to that is, if you have multiple other projects going on, how much time and dedication and team do you have built out to actually run this deal that you're actively looking at successfully, right? And then also comes like, what is that deal specific? Is that specific deal that they have a small amount of money in? Is it $1 million and they're putting in $25,000? You know what I like? What is the ratio there to make it feel like a small amount of money? And what is your, like, is their bandwidth met? Are they just taking on a bunch of projects and lining them up and not going to successfully perform on them? That would probably be my bigger question on that.
Okay. I see what it's at. Gotcha.
Yeah. And even I think the other question, because again, like these are gateways, right? Like these questions are designed to kind of open the doors a little bit so you can see the room. But once you see the room, you know, you have your critical thinking hat on. You're like, okay, oh, weird. Why is this chair over here next to, you know, an open window and it's standing here? Like it's missing. It should be over by the couch or, you know, whatever, bad analogy, but,
Right. Gotcha.
and so when it comes to something like that, it may not be a red flag that there's not much money in there. But if they have the multiple deals, it's like, okay, what is the rest of your team or anyone involved on these deals? What kind of capital is available? If something goes wrong on one of these deals, what is the plan to make sure there is enough capital? Because if they're not well capitalized enough to be investing their own money into all of the deals they're doing, are there other resources they can pull on if something goes sideways and they have to? And you really want to look at your deal that you're in and look at, okay, are the reserve, like how protected is this asset? What do all the different reserves look like? What does the operating reserve look like? What do replacement reserves look like? What is, you know, all of these things, make sure that there's capital set aside to also help mitigate. So it's all about risk mitigation and then also just kind of understanding the bigger picture. So that's where it's like context. Again, context is everything in the story, you know, of like what's behind it and why.
Okay.
Thank you.
Did that answer your question, Dana?
Yeah. Yes. I'm a detailed person, and I know that Carly kindly explained that in the future you'll have a more longer course, and I don't know how to turn that off. So I'm a very preventative person and to be efficient. So you don't ever want to put someone in a position of a legality issue. So of course, you know, the synapses keep going when you mention something. You have a lot of what ifs. So thank you.
Oh, did we answer the attorney part?
Yeah, I don't think so. And I'm curious when you get, maybe it's just one project, it's your first project or what you're investing in, and so I'm just thinking, you vetted them, but there's paperwork and they may have it created by their agent or their accountant or their team, but what do you do? Do you have someone in your, I'm sure you do, have someone in your network as your go-to to review everything. So I think the question is, do you set that up ahead of time, anticipating, hey, this is what I'm going to be doing, and I need you to be my person to review my business. So, I mean, you guys have a bigger streamline than other people that are starting out. I guess I have to say it that way. So how do you maybe vet your attorney?
Ooh, how do you
Or get a reference, I guess I'm assuming. Because not many people know a lot of the ins and outs unless they are the big boys, is the way that I think about it. So
So you definitely want a SEC attorney, Securities and Exchange Commission, securities attorney,
Securities attorney who
or
knows
securities
just-
about
attorney,
the SEC.
not
An
Exchange
SEC
Commission. Sorry, I always do that. A securities attorney.
Yes. So securities attorneys are ones that are intimately familiar with these kinds of structures, about how to remain compliant. There's usually also attorneys that are involved that are the real estate
not the same.
related transaction, but those are not the same. But are you asking in terms of like for you personally, if you're like a passive investor looking to invest into a deal and have someone look at the deal for you?
right. To
Okay.
make sure that, yeah. Because I know there is standard versus custom. Every deal is going to have its own special whatever. But
Mhm.
when you're talking about vetting and screening a deal, I guess your scorecard will help with that. And so I guess I have to look at that, because my thought is, if someone's like, oh, it's 36 months and you should be going, oh no, nothing should go past 22 months, or like, do you know what I mean? Just like, cap rates, there's times and dollar amounts that, once again, maybe it's on your scorecard and I just haven't read it. But you mentioned an exit strategy, and we wouldn't know what an exit strategy is. This is a multifamily for the next 3 years, and I'm 30 years, and you're thinking, no, I want it for my 5th anniversary or whatever. So yeah, I guess it's a case by case basis, and that by experience would be my guess.
And you will know that by your own, like Dana, what you're describing and expressing right now is like what you specifically look for in alignment, right? Like and that applies to everyone. Everyone's going to have their own risk tolerance level, and that scorecard is going to help you guide you slowly into those gates of like
What that is.
giving more clarity on what you find tolerable or your risk tolerance for that, right? It's going to be different than Dave's or Jose's, or you know what I mean? Like everyone's going to have their own experience and risk tolerance. And then I'd say from there, based on what you find in your own findings, and if you're still having some questions and you need a little bit of a deep dive, then I would say go have a consultation with an SEC attorney and say, look, these are the things that I'm looking for in the deal. These are the deeper questions that I don't necessarily have the knowledge or expertise on, that I need to lean on you to answer for me and clear up and see if this is a full green light or a red stop sign for me, right? So I would take it. I mean, it's great to have an SEC attorney kind of waiting around for you, but also like don't make that so you don't take action, is what I'm trying to say.
That's
like
a good word.
take your own, be resourceful for yourself and take your own action, and then what is the next step for you to say yes or no or pass or whatever.
And if I'm not the person who's doing it, and I'm trying to ask this question for everybody else, not just me specifically. What if I'm not the multifamily person, but I'm, say, the bird dog person from my buyer that wants a bunch of investments or multifamily. That's different than buying versus investing. So really have to be discerning there. But is this scorecard good? Well, I'm sure it's good for everything, just for knowledge and learning, but is it a great tool to screen for maybe getting that for other people? I guess is the way I'm saying.
When you say bird dog, so in the community, bird dog is like, hey, I'm going to go find a wholesaler,
Property,
a
right?
property, and then I'm going to go find out who is a buyer for that property, and I'm connecting it, right? So if you want to think it in that terms, I'm going to pull it up like to the 30,000 foot view, because right now we're in the weeds,
Gotcha.
like the securities and stuff. So I'm going to wind back to, remember when Christy and Carolyn have over 50, there's so much experience. They have more experience than me.
Right.
They have a lot of experience. And we said, we're not going to be raising capital yet, but what we're doing to get, we're not going to be doing our own projects yet. We're working we're basically, it's called a fund of funds is what we do. So we have a big operator where it's like, it's not their first rodeo. We vet them. We're like, we know that you know your stuff, and we want to bring you money to your deal. So what we do is you can think of it in that term. So that's called a fund of a fund. So the operator has a fund, and then we attach ourselves and be like, hey, Opal Equity as a whole is going to bring all of our money. We're going to invest it as Opal Equity. And then we're a fund that raises money for a fund. And we have the strategy that we're doing is like, we're not going out there and getting our hands dirty in these big multifamily properties without any deal cycles closed. But what we will do is we're going to attach ourselves to people with extreme experience, a huge team, over $1 billion in transactions with a B. And we're going to do this, and each fund is about 5 years. So we're going to take 5 years to learn. So we're interning under these people where it's not their first rodeo, and we're learning all these things. So we might be like, hey, why did you say no to this deal? And you have to find a sponsor that is willing to just not take your money and teach you. And you use, like, for us, our sponsor had a securities attorney. What we did is we hired that same securities attorney and been like, we know, the lead sponsor, the ins and outs of
Which
this.
is the
you represent us and all of our funds that we raise. We pay them independently. It's called the Opal Fund, or what is it? I can't remember. There's like Opal at Bentry or something is what it's called.
Right.
But so what we're doing is if you want to use the phrase bird dogging, that's a funds of a funds. And so
or connector
or connector. So that's a very similar, but what we cannot do is be like, hey, Dana, somebody with $5 bajillion will pay you for it. There's just it gets a lot of rules and laws.
I see what you're saying. It's yours versus somebody else. I understand. I understand.
So, what you could do if you guys wanted to do that is we have something, because there wasn't really any information when we did it. We were kind of just working with an attorney and hoping they were right, which they were. So we did a whole little course called Funds Formula for other people that might want to be like, listen, I want to raise money in the future. I want to be an operator. I want to be a GP, but I know I have to put in my internship underneath somebody where it's not their first rodeo. And then that's one way you can do a fund of a funds. You just have to find an operator that's like, hey, I have a deal. And then we ask those questions. Like I said, we say no more than we say yes to raising funds for operators because we use the vetting. So you just need to find someone that you would super trust, and you can take with this vetting scorecard. And you could even do your own fund of funds to another very experienced operator after you vetted them.
So, example, say I choose to build a multifamily. Who am I going to? So I have tons of experience in construction and whatnot, but funding wise, I know about bridge loans, and I know the traditional way of going to a bank and a lender and asking for that. But via the way that you're explaining, it's not, you didn't it's not PML. There's another word that you used.
Security. So you would be, if
Securities.
you're
Okay.
pooling together investors and you're saying, hey,
Right.
here's this opportunity, here's what I'm doing.
Securities.
You believe in
Yeah.
me,
Yeah.
give me your money,
Right.
basically. Invest your money here. It's gonna be a good investment. Yes. Then you
Right.
are likely selling a security. And so then you would work with the securities attorney to structure that and to create a syndication,
Got
create
it.
a
Now I
fund
get it.
that now they're investing into.
Now I
Which
understand.
which
Yes.
raises something like we are harping on an operator in like this level of experience of like going full cycle and who you're giving money to. But I think that this is a good pause point to say like that is our opinion about this, okay? And again, it comes down to context. So like Dana, you could go out and you could be phenomenal in like construction and building and all of these things. And we are not saying like for someone else that like they should not invest with you. They just need to understand, and this is what the investment scorecard is about and what we're trying to kind of teach is like really it's about like understanding where the risk is. Like they might know who you are and what your experience is. And they're like, I understand that Dana hasn't done this before, but you know what? I'm good with this risk. This to me is a good risk to take. I believe in her and I'm putting my money there. So just because we are saying like in our thing or like this is could be a red flag, it doesn't mean that it always is. And it doesn't mean that you as an investor or you as, someone who's raising capital can't come to a different conclusion about it. It's
Right.
about, it all comes down to risk level and transparency. And if you are the person that's not the one doing the wiring, but especially if you are the person who is taking someone else's money for your own deal or to put into someone else's deal, that level of transparency is so important because that investor's trusting you that you know what you're doing and that
Right.
if you don't fully or you're not sharing the fact that like hey the deal we're investing into it's their first time ever doing this and your investor doesn't know to even ask that question then you're not doing your duty as being a responsible steward of that so that's kind of my big caveat with all this stuff
Thank
like
you, Christine. I
no
love that
problem.
explanation. I appreciate that. That
Yeah.
pinpointed it very well. Thank you.
Okay, good. Yeah. So don't use our investor scorecard and think this is a good deal or a bad deal or this is comprehensive. It's high level, it's over key areas, it's to get the ball rolling and for you to start figuring out what's important for you. I can tell you right now, it does not have everything, not even close. It's
Not even
just high
close.
level. Yes.
Perfect. Thank you.
So, question for me, I just want to I like this a lot, and for me, I need to be um, more knowledgeable with respect to this, and so therefore, your course I'm going to be taking, but I've also found another. I don't know if this is the same thing as far as multi-level acquisitions, and it goes to the exact same thing of fund to fund. But he goes line
Yeah.
item by line item by line item by line item to go ahead and learn this stuff. So the combination of both of these things should get me where I want to be.
Yeah. That
Yay.
is a great book. I couldn't fully see. Is it whose is it? It's the
Beardley,
underwriting, barely, right? Yeah, he
Beardsley,
has a couple
Robert
of
Beardsley.
different ones. So
Yeah.
that's a really good book that'll walk you through like underwriting and really understanding the structure in the deals. He has another one that he's written. I haven't read that one, but it's all about structure, like debt structure, capital stacks, capital, all of that. So those are really
So
good
did you think this
resources.
was a good pickup to go and read through?
Oh, absolutely. Yeah. I would say like if you're serious about vetting deals, especially if you're moving into more of a role of like you want to be a fund manager, or you want to buy and acquire, like be a GP and be more active, absolutely. Like that should be material that you go through and sort of
How
understand.
how is this book different from the course that is the fund to fund course that you guys that Opal Equity is?
Yeah. So the funds formula that in our course, we cover vetting. We don't go to the level of detail of that. It's more of here's the areas you want to vet. We don't specifically go through and say here's how to underwrite deals with like a calculator and doing that and calculating returns and doing all. So that book will walk you through more of like how to underwrite specifically, like a deep dive. The course is more of like if you want to put together a fund of funds and do what we're doing and scale and find good quality operators, it's all the pieces of what we wish we knew in the structure to to be able to do that effectively. And we cover a wide range. So we're covering like marketing and brand and going over like OMs and webinars and raising capital, how to do it legally, how to do it lawfully. We go over fees. We talk about vetting sponsors, vetting the deal, building your own team, like who should be on that, what the roles and responsibilities are. So it's really about like the business of the fund of funds, what it looks like, understanding how it works, and how you put it together yourself and what to expect.
Okay. Thanks. I appreciate it.
No problem.
Great questions. Any other questions, you guys? Is everything clear as mud? The vocab guide is going to be very helpful for a lot of this too. So as we're going, I'm hearing words and I'm like, let's make sure that's in the vocab guide, the K1s and everything. So Christopher, you have your hand raised. Hi. You had some good questions in there in the chat.
Thank you. My question is, do we need to start an equity fund? I was presented with so many opportunities in Nashville that like multifamily apartments, RV parks. I've got a huge opportunity with I can't say because I'm under a non-disclosure agreement. But I mean, developing parcels of land and bringing that kind of capital to them. How do I go about structuring that whole entire thing?
That's probably a fund of a fund, likely. It depends on how they have everything structured, their experience, like you'll see in the Howey test. I wonder if we can put it in there again there's like that little handout that we have that has information on the Howey test. You're gonna want to make sure.
I downloaded that through the link that you guys and I sent it there and put it on my phone. Like I said, I'm driving, but like I said, it's like these people that have legitimate deals and they want 250 unit apartment buildings and they need the capital for that. And so I'm like, okay, let me go find the capital. If I go to like a hedge fund or a pension, would I be considered a broker if I'm asking for money for that? Or do I need to ask them for a partnership inside of their opportunity? That way I don't want to get in trouble. It's just people bring this to me all the time and they're not small deals. These are multi-million-dollar projects.
Well, the first thing is, Christy's going to say something, but first thing is you need to vet these people before you even think about if it's legal or anything. Vet them first. What's their experience? How's the structure? Look them up on the Edgar. I want to put that in there, but I know go ahead, Christy, you had something.
Yes, you said the word broker. So when you're dealing with securities and you're dealing with all this, and this is where it gets really tricky. But basically what you're asking is, how do I make this connection between the money and the deal and I get paid, right? Essentially is what you're asking. How do I get a piece of it? And it's very challenging in this space to do that because there's a lot of rules around that. So you have to be super careful. And basically the only people that I'm going to give a few caveats, and then I'm also going to say, go talk to a securities attorney and don't take anything that I'm saying is like what you should do.
Right. Well,
there's broker dealers. Which is a bit different from a broker. Broker dealers are people who can go out there and they can get paid for doing that. They can earn a fee. You also have the option of becoming part of the team. So that would be one thing that you can discuss with them of like, okay, I'm part of the GP team. I'm bringing money to the table. That one also gets a little tricky because you have to be careful with how that gets structured. They need to give you a piece of equity, whatever that is agreed to up front, before you bring the money. And that needs to not change no matter how much money you bring. So what I mean by that is you would negotiate with them. Let's say, hey, developer, I can bring $2 million to this project. And they're like, okay, cool. That's worth 5% of the deal to us. So we will give you a 5% equity share as a GP for doing that. So then you go out and let's say you bring in $0. you're like, shoot, all those relationships fell through. I wasn't able to raise a dollar. You come back, and it's like, yeah, I didn't raise anything. They need to, in order to stay compliant, they still have to give you 5%. They cannot go up, they can't increase, they can't decrease. So that also means you go out, let's say you raise $10 million instead of 2. You still only get 5%. You don't get the at that point, because the important part there is you can't be paid for performance. And when it comes to raising capital and bringing in money. So the actual amount, it can't be tied to how much you raised, and you get compensated for that. So that's one. 2, there is another way that you can get paid, which they're like referral fees, basically. And the way that these work, it's risky on the developer side because, again, I mean, both of those are risky for them, right? They bring you in as a partner, not knowing if you can perform, and they have to give you equity no matter what. The other way also is risky because what they have to do is they commit to you up front. You guys agree on whatever fee for whatever arrangement. But what it is really just an introduction to that person who has the money. So it cannot be, so it might be like, hey, we will give you $1,000 for each accredited investor or whatever, in this case, it would probably have to be accredited because unless you're part of the deal, you can't really connect someone. But that's a whole different, we're not going to go down a 506B road. So an accredited investor, you bring them to the table and basically they pay you no matter what, as long as it was a qualified person in introduction and it meets whatever the criteria was up front. But it cannot be contingent on whether or not that person invests. So that you can bring that, right. So they pay you $1,000 whether or not the person invests. So there are ways to do it. It's just from the person running the deal. And we can say as fund managers, it's one that we struggle with because we have people that come to us that are like, we have connections. We want to connect you, but we want to get paid, and it's like on our end, it's very hard to negotiate those because we're putting a ton of trust into that person because we're basically saying we're going to pay you no matter what. And here's what our arrangement is if we move forward. So more often than not, it doesn't make sense to move forward with those.
Okay. Yeah, that's what was talked about today was, they weren't looking to put equity and bring a lot of people into the deal. If I was to bring, money to the table with everybody, they go, we don't want to divvy out equity checks to everybody into this project. Because I'm needing to raise about 1.275 million for now. And then they have a goal to do 15 RV parks in the next 3 to 5 years. And so pretty much one every quarter for the next 5 years is what it sounds like to me. So yeah, there's still a lot I've got to learn. I'm reaching out to other investors as well. And taking this information here is helpful.
Okay.
Sorry, it's hard. It's hard for me to kind of focus and drive at the same time, but it's something I needed to have answered because that's kind of what they were saying. Like you were saying, I was like, well, maybe if I split, it's like I need to put myself into this deal where either I partner with you guys on this, but they want to pay me contingent upon performance. And I'm going, well, if I'm doing all this legwork and I'm not getting paid for something, and I'm putting all the legwork and it doesn't go through, then it's like my efforts were futile anyway. And so do I want to put this amount of effort into something that I possibly could be paid?
Yeah. And that's where I think, when Carly said it in the very beginning, before I brought up the other scenarios, it's like, it sounds like this would be a scenario in which a fund of funds is a great strategy because what you do is you raise capital, you're controlling the investor relationships, they're investing with you, you're creating this special fund where you're like, okay, $1.75 million to invest into this deal. And you basically are saying, here's one big check that's going to the developer. And your fund is acting as a passive investor, basically. One big passive investor going into the deal. And by doing that, you are able to, as a fund manager now, to collect fees as a fund manager for managing that. You just need to make sure it's structured. And this is where we go into a lot more detail in our funds formula course, but making sure that whatever you're buying, the share classes you're buying into in their parent fund, you're not diluting returns for your investors, that there's enough meat and there's a way you can purchase higher shares because you're a larger check, that then you get to kind of take some of the cream off the top to pay yourself, and then your investors aren't being paid double fees for you being in the middle. So that might be a structure that you explore in this case. It sounds like would be a much better fit.
And
yeah, and that's what I was getting to say. Go ahead, Carly.
Sorry. I just want to piggyback off on that. So you really, I hate to bring it back to vetting, but you really want to vet these people before and make sure, because with funds of funds, we put a lot of money into this to even raise money. And with the funds of funds, depending on the lead sponsor, if you don't raise X amount, you might end up coming out more money out of pocket just with attorney fees, your time, getting things going.
Right.
So
it has to make sense.
It all goes back to vetting. Like, don't put the cart before the horse and be like, how do I do this? Are these people, that is a big undertaking to do one park a month or year, or whatever you said.
And Christopher, like, you may have mentioned it or not, but like, have they done this before? Is this their first rodeo? Have they gone full cycle?
Yeah, this is their first rodeo. I mean, I've been vetting them and talking to them. In fact, Pace has already talked with them as well too. And so this is one thing that I've spoke with them about, and it's just like I know that they have a deal working with Pace on this, and they're going, well, he's going to do this one, but we have 3 more that we'd like to purchase by the end of the year, 2 more to purchase by the end of the year, and then start the next quarter as well too. You know, where they're going to start doing 3 of these per year for the next 5 years. And that's just one deal. And I didn't get to vet everybody because, you know, at this networking event, it happened so quick. And I mean, it was like left and right people. I mean, 17 contacts in 15 minutes with people wanting these opportunities. And not to mention, I'm working with the head of security of Shaquille O'Neal. And that Shaq's not involved in this, but I'm talking a major multi-billion-dollar project. And so I'm going, okay, these people are coming to me because I need to form an equity fund, kind of like you ladies have done, with some big investors that are willing to pull money together to get double-digit returns, because that's basically what we want to do, is bring money back to our investors. So they bring money back to us, so we continue to do the same thing, and then, like I said, make our cut of that as well too. So, I mean, a lot of information was given to me that I need to digest, that I know I can structure. I just got to have that right guidance in order to do it, to get the right people into the play.
And keep in mind, people will throw around big names like Shaq and Pace. And keep in mind, these guys.
No, I was actually on a Zoom call with these guys. I mean, I'm talking to the senior vice president of Merrill Lynch and Bank of America. I was literally on the phone with them.
So this is not their first rodeo. They know how to protect themselves. They know how to. I guarantee you, just knowing Pace and Shaq and anybody at Merrill Lynch, they are not going to lend money unless they have attorneys and it's not their first. They know how to protect themselves.
Correct.
Where I'm not saying you don't, but I'm just saying it's like a whole different playing field. Just, like, so they might be like, I want this or this or this in the contract, because I am not. They're a reason why they have so many things. So be very careful. I would just don't get caught up in just because so-and-so's doing it means you're going to get the exact same thing and the exact same structure. Really vet them.
Partner
with somebody where they've done it before, because you don't know what you don't know.
Correct. And that's it too. I mean, in opportunities, I mean, like you were saying earlier, vetting people as they come up to me. I need $1 million for my property. I'm like, okay, why do you need $1 million for your property? Well, I'm behind, on the mortgage and arrears. And I'm going, okay, basically you want me to pay off your debt that you didn't pay off before. How are you going to pay that back to me? Well, you can have a position. I'm like, well, you've already got the mortgage company with the lien. You got a lien from the guys where they did the renovation on it. And I said, so I'm already in third position looking at this. I said, I'm already going to tell you, my lenders are going to say no. I mean, I really just kind of look at, listen to them talk, and I keep listening to them talk. And the more they talk, the more I'm going red flag, red flag, red flag, red flag. I mean, I did that a lot this week.
Well, that's
I've been
good.
told.
I think
So,
that,
I mean, like vetting them and then just knowing who's serious and who's not.
yeah, at these networking meet, like I think everybody's been bombarded, and it feels really great to network, and it feels really great to make contact and collaboration. But again, this is a blanket statement. I'm not just saying this to Christopher. Your personal risk tolerance should not is not going to be identical to Shaq or Pace or
Correct.
Do your due diligence and do your best to make sure you are in alignment with your goals and your financial well-being, not to shove anything aside in order to be in a deal with a specific person. It doesn't matter who they are. Just, I think the bottom line here and what we have gone into in this Zoom is like really big on alignment. Does this align with your values, your financial goals, X, Y, and Z? And actually take these questions into high consideration when you're coming across these big deals, because it is very, what I want to say, like it feels good to have opportunity in the palm of your hand, but not every opportunity is the right one. So yes, be asking these questions. A big thing for me is like, if they've not even gone full cycle on a big project that they're wanting to churn and, I shouldn't say churn and burn, but like one after the other, after the other, after the other, it's like, okay, that's a big pause for me.
Right. Well, that's it too. I mean, and I'm honest as the day is long, and I'm really direct, and they're going, this is our first one, but this is our goal. I go, well, maybe you should just do one deal first and let it go for some time before you understand the process and the undertaking of what it's going to take to operate and build that business, and then understand how the operations work. Because to me, it sounds like they're just trying to find turnkey RV lots and then, soup them back up. But I know that time right now is constrained with you ladies. I don't want to take it more. I could probably talk with you all day about this because I just need more knowledge, more information.
I think he's driving, so he's probably
We can hear him.
Oh, I can't.
I think it's your connection, Carly.
Sorry, I didn't mean to interrupt.
No, okay.
Oh, no, you're good. But maybe I should just set up a time where I can talk with you guys, maybe 15 minutes a time, to be more specific. That way I'm not, holding up the rest of the group's time as well either, because I could talk about this all night, just to get the knowledge and understanding. I'm an electrical contractor by trade, so I'm not afraid of big numbers and millions of dollars. I did Walmart supercenters out of the ground up. So it's not the money factor that I'm afraid of. It's really just making sure I structure the deal correctly, where I create wins for everybody all the way around, and then divvy out the money the way it's supposed to be. That way I can get my investors to come back and say, man, I had a great return with him. And then they turn me on to their friends as well, too. And that's like what you ladies have done, is building, the Opal Fund or, Opal Equity Fund. I'm a student and I'm always learning.
Keep in mind, this is, if you have one thing, because I hear you. You're like, I'm not afraid of a lot of money, and I hear you on that. But also look at it from this lens. Would you gamble your parents' livelihood on this person? Because what you're going to be doing is you're going to be going out into the world and say, trust me, bro, pretty much. Mm-hmm. Gamble your retirement on this deal. And everybody is different, but my thing is like, oh my God, if I'm like, yo, trust me, this person's good, because I'm not afraid of big money, and they had Shaq on a call or whatever it is, like these big things, are you willing to risk losing other people's retirement and livelihood on this deal? That's a good question to ask, because there is a chance the money will not be returned, and there may be no recourse. Yeah, exactly.
And that's what you were talking about earlier, is reputation. Mm-hmm. And when you build a business, your reputation's everything. And then it's don't trust but verify. And I always, with my customers, I would make them verify me. I was like, you want references? Here's 1,500 references. You want anything else? Here's an A+ rating with the Better Business Bureau. You need anything else? Here's the number to the Construction Industries Board. Ask for this person directly. That way, you know that I'm going to let you verify me, because I'm not afraid of that, because of who I am as a person. Not every person is like that. I always ask them when I was talking to these, I go, would you let me have the FBI do a background check into you? You know how many people turned and burned when I said that? A lot.
Yeah.
A lot, because I go, that's what I will do, because it's not my money, and that's how serious I am about protecting the person's money that's trusted me to invest it.
Yeah, for sure.
So yeah, I mean, that's verification. That's verifying. Will you let me verify you? Because I'm going to do a deep delve into your background to see who you are as a person. And like I said, I'm still learning. I'm helping people kind of get on the ground. Ask them about their credit score. Do you know your credit score? A simple question like that. People don't even know their credit score. I go, well, what's your credit look like? What, like you said earlier, and I spoke to these ladies about it. I go, the more skin you have in this game, the more likely you are to get investors to come forward and put money into it too, because they know it's not just going to be their money going into the deal. I said, so how much capital can you guys bring into this as well too? 100, 200, 400,000. What? The more you have into it, the less that you have to rely on other people bringing into it, and the less you got to pay back, and it allows for you to roll into your next deal.
Yeah,
that's kind of my thought process on it. Like I said, I'm still just a rookie at this. I'm just an apprentice, learning through my internship.
Yeah, yeah.
Always be a student.
We're always a student. Always be learning. Great stuff, you guys. Do you guys have any other questions? Oh my gosh, we're coming up on almost 2 hours.
Wow. Y'all have fun.
We're all like, I don't know if we should do it this long. I don't know if people really have the time. We've lost about half people, but if you guys have anything else, come to networking, theopalfund.com / whatever the slash is, events. I always call it backslash. It's / get the too, but I don't know what's wrong with me. Christy, thank you for putting in the chat. We also have the scorecard. Get that scorecard, get in there. Be a student, ask the questions. And we're so grateful you guys came and wanted to learn from us. Thank you so much for being here. Thank you for asking great questions. It's so good to see your guys' faces. I see some new faces, some old faces. And all right.
Thank you, ladies.
Yes.
Very informative.
Yes, of course.
It really was. It was really, really informative. It's got my brain going a million miles an hour right now. So
good.
Kind of woke me back up. I appreciate you, ladies. Thank you very, very, very much.
Yes.
What would be super fabulous for us and sings to our hearts is if you do use the investor scorecard or that vocabulary or just whatever value that you've gotten from our 2 hours together on a Friday afternoon, share about it, give us some feedback. We love spreading the love and having more people join in and learn with us on these educational Zooms and our networking Zooms for that matter. So please share away. Please give us your feedback, and we hope to see you in the next couple weeks after Thanksgiving. Have a great Thanksgiving, by the way. I know it's a little bit
happy Thanksgiving.
Yeah.
Happy early Thanksgiving to everyone. Our next networking Zoom will be December 5th on a Friday, same time, 1 p.m. Central.
And if you guys found value in this, feel free to share the scorecard with other people, and feel free to tag us and let us know what your biggest takeaway was on social media. If you do that, and give us your feedback. If you're like, I wish it was shorter. I wish you would have talked about this. I wish you wouldn't have done that. I wish you would have talked about, I want to learn more about data. Let us know. We're here to serve, and we want to bring you guys along the way. We have Lee here. I'm going to call Lee out. Lee was in our founders of our fund to fund formula, and he's about to close next week on a 28 unit multifamily deal. And he told us that, and we're like, This is why we do it. Do it. Thank you. We love to see people win. So,
Holly,
yes.
Don't forget the 1 in front of the 28.
Yes, 128.
128.
Oh my God.
Yeah.
Sorry. It's a lot.
One of the biggest
That's
things
awesome.
I can tell you guys, take the course. That gives you so much knowledge, information. If you want to vet and you want to test your risk level, take the course. It is so informative, and it gives me so much info to go to a deal with so much confidence. And right after that, it happened. I was able to vet my GP and my sponsor and investors and take the course. And I'm keeping my fingers crossed. November 26th, day before Thanksgiving, we're supposed to close.
Yeah.
Oh my God. I cannot wait. Will you give us an update when it's done? I'm just so excited for you. Anna said which course? It was the fundsformula.com. We'll put it in there. It essentially shows you guys how to, if you're going to use that phrase, the bird dog or the connector, how you can connect a vetted sponsor that you use the scorecard with first to money, and you can get paid for it.
And a quick recommendation when you download the scorecard, like we said, the vocab guide is linked within the scorecard. I would recommend not making a copy of the vocab guide yet. We specifically have this as a Google Word doc, because it's a live document. And what we're doing is we're realizing there's all these extra terms or things that we want to like elaborate more on. So even in this call, we were making notes as we're going through, like, oh my gosh, I don't know if we really said that. There's so much in multifamily and in all of this, like all these terms that come up. So we're still adding on and building this thing. So I would just recommend keep the URL like bookmarked or something, and use the live doc just as a reference guide. Don't make a copy yourself, because you won't get those updates. So
we weren't going to always be providing more in there.
Yes.
I have a feeling, it's going to be an ever evolving.
I have a whole list of things. I'm like, did we put that in there? Did we put that in there? We used all these words. So
yes. Well, thank you so much, everyone. It was such a pleasure to have you the last couple of hours. So hopefully you learned a couple of things, and we're excited.
And share away. Let other people spread that guide that checklist like wildfire, because so many people don't realize, this with this it's just questions. So share it. It's free. Free for all. Share it, please, with others.
Free for all. Free 99.
Everybody needs to be safe.
99. There you go.
Yeah. Here's the link again. Our preference would be that you share the link, not the scorecard itself, just so that as we make updates and things, like, we know who has it, so we can be giving updates, right? If it's just the scorecard by itself living out there that you're sharing, then we don't have a way to contact those people. So there's the link again. That's what you can share if you do find it valuable and you want to share it.
Thanks, guys.
Thank
have
you.
A good rest of your day.
Have a great weekend.
See your faces. Thanks for hanging in there with us. I know we had a little bit of a rough start, but we are going to fix it for realsies next time. We appreciate you guys. Thank you. Thank you. Thank you. Thank you to everyone.
Thank you. Happy Thanksgiving, everyone.
Have a great week.
Bye.
Bye.
Happy Thanksgiving.
Bye-bye.